would appear, if you look at the overall recovery that we've had here as the NASDAQ moves into the green on the year, that mostly the market has been digesting the way that the Fed has been addressing the slowdown and is generally optimistic that a quick recovery could still ensue here. If you don't want to call it already a recovery, at least in the stock market, the underlying data that we're getting on the economy as well here as we move further along in the year. For more on that, I want to bring on a guest who was quick to call the recovery off the March bottoms. That would be Tom Lee, Fundstrat Global Advisors Managing Partner and Head of Research, joins us once again. And Tom, it's good to see you. I love having you on the show because you've been pretty accurate in your calls here from what we saw play out after that March bottom. You said we'd see a quick snapback, and if we held that 50% retracement levels off those lows, that we should be in the clear here. The market's generally held that line, about 2790 on the S&P. I mean, when you look at that, are you even more surprised that this continues to hold up? I mean, it sounds like you're surprised that you're even calling for a recovery off those March bottoms.
Yeah, I mean, I would say I agree with most people who think, look, there's no visibility now, and that creates uncertainty. But too many people are sort of taking uncertainty and then saying, oh, well, the stock market's irrational. I think the market has been really resilient. It's been a clockwork recovery, which is good because it shows the markets aren't broken. But the fact that it has held the 50% retracement, I do think is telling us that it's looking past all this horrendous data. I mean, we've had a gauntlet of the worst data in history, and the stock market is well into a bull market.
Yeah, and I mean, that's been kind of the question mark, is whether or not it is a bull market versus just a bear trap. We've heard differing views on that front. But I mean, it's not just equities. So we were talking before the show, you were highlighting spreads in the credit market as well, other signals out there. And we, of course, have moved pretty much to the end of earnings season here after Q1. And you look at really sector by sector, financials and discretionary mainly delivering the pain there. And some of those names you've even talked about entering into. So, I mean, as we move into Q2 earnings season down the road, are you still looking at some of those sectors that might have such low expectations that it might be easier for some of those names to top?
Yeah, I think it's important for investors to barbell. That's kind of what we're recommending, that you want to have a pretty big component of secular growth names like the FANG and the cloud and the natural winners who've become a lot more useful during this crisis. But there's so many companies that have been caught in the epicenter of this COVID-19 that aren't structurally broken. And so it's like you said, within consumer discretionary financials. And those are the names that you also want to own because, one, when the crisis does abate, and I don't have an idea when it abates, but when it abates, these are going to look past 2020 and even 2021 earnings and start to go back to what these things are on a present value basis. And it's a huge recovery. I think we published a piece a couple of weeks ago showing that if they just catch up to where the S&P has recovered to, you're talking 50, 60, 70% upside for those names.
Yeah, and some of those names would be, I mean, we've highlighted a few of them on the show, but you were looking at Gap, some retail names as well, some restaurants, Darden included in that. I mean, it seems like you would have to wait. As you said, you don't know when the actual all clear might happen. We're seeing states open up right now, but I mean, if that's the valuation basis you're operating on, how long would it need to be before you get back to full recovery and everything operating as usual to see some of those names fully catch up?
Yeah, well, it's important to keep in mind stocks recover before earnings and earnings recover before GDP. So if we're looking at when GDP recovers, it probably is at least 2 years away, and that would be similar to what happened in the great financial crisis. But earnings could recover a lot more quickly, and a lot of it has to do with cost engineering. As you know, in every crisis, companies really take a hard look at their costs. The two biggest costs today are labor and real estate. That's close to 50% of the cash operating expense of the S&P 500. So if companies are going to be engineering costs in this cycle on a much lower level of revenues, they're going to have higher earnings. And so I think in 2021, we might get a pretty big surprise.
Hey, Tom, it's Brian Chung here. So when we talk about, I guess, the rebound that we've seen in the equity market, it seems like many people would have missed that bottom if that was indeed the bottom. But as far as asset allocation goes, I mean, you were talking about consumer discretionary. I mean, picking stocks in this environment, it seems like it wasn't even 6 or 7 weeks ago that everyone was hiding in US Treasuries. So, I mean, what is the optimal allocation at this point, especially when you mix in even things like crypto? Because that whole happening story is actually something, I mean, refreshingly, that isn't COVID related, right? Is that where you're supposed to be finding investment opportunities?
Well, since the March lows, and it's our firm's view that that is the low, and you haven't had a single instance since 1929 where you had greater than a 30% decline. You cover your 50% loss, and then you make a new low. So it would be unprecedented for this to be a new low to come. But I think risk-on assets should be a pretty big exposure, because part of it has to do with, monetary policy is really supportive. And I agree. I think crypto is a really useful hedge here, Bitcoin in particular, because if you're leery about, all this fiscal money and monetary printing, Bitcoin is digital gold. And even Paul Tudor Jones, who is really one of the best known commodity traders, says Bitcoin reminds him of gold in the 70s. But I think you got to own some epicenter stocks. That's the strategy that worked in October 08. So even if you think there's, another low in 5 months, in October 08, you had to buy the epicenter of the financial crisis, including some of the home builders, and you made money. I think that's the strategy you want to employ today.
Yeah, since Brian dipped into the topic here, I do want to stick with Bitcoin, though, since we did hear out of Morgan Stanley, interesting, we haven't really heard a lot of inflationary calls yet, but they were among the first here, issuing a new paper saying the return of inflation could be here by 2020 when you have those inflationary pressures and you talk about the Fed stepping in here on the monetary front. All those things considered, is Bitcoin right now, since we're about a couple hours away from the halving process right here, when the reward gets cut in half for Bitcoin miners, I mean, when you look at that, is that priced in? Are the inflation fears priced in? I mean, it seems like this is the first time I'm really hearing a major analyst talk about inflation in real terms.
Yeah, I think inflation has a greater chance of happening today more than any time in the past 10 years because of how much how much easing has been taking place by central banks everywhere. But in the US, I would say most of us think of it as wage pressures. And, the only times you ever really get wage pressures is either a radical shrinking of the workforce, which happens during plagues, or during, post-war periods, or if prosperity is so strong, you've gobbled up all labor. So I think it's a possibility, but it to me, I don't think you and I would think of it as inflation if it's taking place. But yeah, if you are worried about inflation, it's really talking about debasement of the currency that you own. And, one of the best hedges is something like Bitcoin, which, has an inflationary policy that's very different than how central banks print money.
Yeah, and we're going to see that play out today. As I said, just a couple hours away from that event happening, the halving. Real quick, though, before we let you go, I mean, the call, as I said off the top, it seemed like you kind of admitted, look, I know that this sounds crazy, but the speed at which we deteriorate should be a function of how quickly we snap back here, that you might not think that would happen. It's played out, though, when you look at the 50% recovery. So now, moving into leg 2, you did call for getting back to all-time highs pretty much by the summer, maybe into the fall. So, I mean, when you look at that timetable, are you still sticking with that based on what you've seen so far with this recovery?
Yeah, I know all-time highs sound just ridiculous to somebody, but consider the fact that the NASDAQ is pretty much there. And so it's really saying, okay, well, the epicenter stocks, can they stage a recovery? So let's just say FANG and Cloud, and that's, a very large percentage of the market is static, but then you can stage a recovery of these epicenter names, which I think is possible. Then you're already going to be at all-time highs because, it's not like the whole market has to make a huge move. It's really the epicenter stocks have to come out of the basement.
All right, there you go. The update from the man who at least called the first leg of his prognosis of the recovery, Tom Lee, sticking with what he has called for there. Appreciate you taking the time, Tom. Appreciate it.
Hey investors, Zack Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.